Hi, everyone, and welcome to season 4 of our podcast where we are talking about financial products that matter to you. My name is Medha. I'm the founder of WealthUp, and we're here to help you make smarter financial decisions. What does that mean? Is that resources, tools, and services that help you understand whether a financial product is right for your portfolio, it's right for your financial journey, and how to get to your financial goals faster. In today's episode, we're going to be talking about leasing assets. So, essentially, what does it mean to invest in asset leasing? And we have Nikhil here to talk about it, he's the founder of Grip, and he'll talk more about that. But we couldn't find a better person to be covering this topic. So, let me first call on Ankit, my co-founder, to introduce himself. So, over to you, Ankit.
Hi, Mida. Hi, everyone. This is Ankit. I'm a founder of WealthUp. My background is I did engineering from BITS Pilani and worked as an investment banker with Swiss Bank in New York. And now we are running WealthUp.
Thanks so much, Ankit. And now I have Nikhil on stage. Nikhil, I would love for you to introduce yourself and tell us a little bit more about what inspired you to start Grip, why you felt that there was a gap in the market or a need to start, something like this. So over to you.
Thanks so much, Medha and Ankit, for having me. Pleasure to be speaking to both of you. Maybe quickly on my background, like Ankit, I also started my career in investment banking with Morgan Stanley. I spent 6 years there, but this was between 2010 to 2016, and I got a chance to work with some of India's the earliest entrepreneurs building payments businesses, classifieds businesses, in my role at Morgan Stanley. It was also the reason that the entrepreneurship bug bit me, and in 2016 I co-founded a company called Chalo, which is one of India's largest mobility startups in the intra-city bus space. Chalo today operates buses in about 30 cities and facilitates about a billion passenger rides. So my co-founders have done a great job in scaling the business. I moved on in 2019 and joined the World Bank for a stint for 2.5 years as a consultant on policy making for transportation and electric vehicles. And post that started Grip. Um, I think the inspiration for Grip, Medha, to your question, also came from my work at both Chalo and at the World Bank. I saw a lot of companies, Chalo included, requiring capital to purchase assets. In our case, buses. But if you think about other companies in the mobility space, it would be cars. For companies like Zip Electric, who operate two-wheelers, it could be two-wheelers, it could be three-wheelers. And then if you expand the scope beyond mobility, it could be any asset, right? Many of you may be familiar with Furlenco, which does furniture rental. So for them, it's furniture, but it could be electronics, plant and machinery, etc. And while these companies had a genuine need, a good business model, they were not necessarily being able to access traditional bank finance. At the same time, we saw the desire from individual investors to have access to such investment options which gave a higher rate of return. There was obviously a certain degree of risk, but they gave a higher rate of return. And Grip started as a platform to match individual investors, or what is called retail investors, with companies, allowing them to lease assets and make fixed rental income. So that's the inspiration behind Grip. In fact, our first deal was a small deal for leasing 50 Hero electric scooters to Zip Electric, and then since then we've obviously scaled the asset leasing business and then diversified into other assets as well.
Thanks so much, Nikhil, for sharing that. So now, Ankit, over to you and Nikhil to take us forward in this conversation.
Sure. Thanks, Mida. And Nikhil, thanks for sharing, the idea behind Grip. You mentioned a few things here. So first of all, let's just break down the leasing into very like simple terms, to a layman, what is leasing?
Sure. In the most simplest form, and maybe Ankit, I'll use you and me as an example. Let's say you want a vehicle, but you don't want to purchase it. You'd rather say, I want to use it for three years, but I don't want to own it. Right. I, on the other hand, am happy to give you the vehicle. I'm happy to make the investment, give you the vehicle, and charge you a monthly rental for the use of that vehicle. This construct is effectively a lease. Now, I have given this example for two individuals, but it is also true in the case of companies, large companies, and maybe the easiest example to give is Indigo. Indigo Airlines largely leases planes that it operates. It does not buy them. It leases them from very large leasing companies across the world. And this allows it to operate its business. So that is leasing. It gives one company a non capex method of accessing assets that it wants to operate, and it gives the other company a form of investment or return on investing capital in purchase of assets.
Right. Got it. Okay, and you also mentioned that the return is on the higher side, and but also so is the risk. So first of all, you mentioned that these companies may not have easy access to the banks, right? Generally, the return is higher. So is it like the banks, if they would have been lending money, it would be at a even higher rate compared to what they are getting the assets on through leasing? Or what the situation is, because if it is cheaper, there is no it doesn't make sense for them to come here. And what is the kind of risk that we're talking about?
Sure. I think it's a little bit of a complicated answer. It's not that simple. Um, if you take a step back and see how India's financial infrastructure is structured, right? Banks largely lend to companies that are double A or triple A rated. Basically, the largest of companies with the best of credit. I won't get into what the reasons are, but that's the fact today. As you go down, as you move from banks to NBFCs, you see them lending to companies that may be double A to A rated or triple B plus rated. Uh, and beyond that, the access to credit sort of disappears. Partly, alternative investment funds like venture debt funds or performing credit funds have tried to meet that gap. But India by all standards is still a credit starved country, whether it is for individuals or whether it is for companies. At the same time, individual investors don't have access directly to these investment opportunities, right? Even the minimum investment amount for an AIF is 1 crore rupees, which
Yeah.
most of us cannot access. So that is where this ability to earn higher returns comes, where the traditional financial sector, just by its nature, is not going down below, say, an A rated or a triple B plus rated company. And hence, those companies that don't have that rating yet, but are still solid businesses, do require other forms of capital, and they're happy to pay more for it.
Got that. Okay. And so, when we're talking about, okay, so obviously we are not talking, the minimum investment is 1 crore or above as it is with the AIF. So we are, talking about retail investors. So, any specific type of investor that who should be considering investing into leasing assets?
Sure. I think leasing assets falls largely into a category that people say is alternative assets or high yield investments, right? And this is, we're talking in the fixed income space. These are obviously not equity investments.
Mhm.
I think in general, I would say, as someone who's beginning their investment journey, it's great to start with the more traditional asset classes like fixed deposits and mutual funds. I think once you have built some amount of corpus there, you have experience, you've seen the volatility of the stock market, you know what you're likely to react to it, what your risk threshold is. I think that's a good time to begin exploring all types of alternative assets. It could be asset leasing, it could be corporate bonds, it could be other forms of assets. But I think that's the right time. Most of the users on our platform are above the age of 30, right? Because they've spent 5 to 6 years in a job, built some amount of savings, done the traditional stuff, and then are then looking to diversify. The caveat I would put, Ankit, there is, alternative investments as a category is fairly broad, and each of us can define it differently. Many of us would think that a corporate bond, which is a even a double A rated or triple A rated, highly secure, almost no default rate, is alternative because people have not had access. I think
Mhm.
those are products that people can look at beginning their journey much earlier in their life.
And because primarily it's because of the rating that we're talking about, right?
Primarily the rating, which is a representation of risk, right? So a AAA rated bond, and this is data from CRISIL, in the last 10 years, there has been a 0% default in a AAA rated bond. In a AA rated bond, it is 0.18%, right? So the risk is, it's very little risk to take, but the returns are still far more attractive than at least a fixed deposit.
Got that. Okay, cool. Okay, and say when you started Grip, this was mid to 2020, right?
Yes.
Like it's sort of immediately after COVID, and the interest rates were like at rock bottom, the lowest, that we have seen. And then of course, now we are seeing interest rate which are at sort of the near time, like 10-year high or so. So when you started, interest rates were low. How were the kind of returns that you were offering back then? The IRR that you were offering, how it is now, and it is broadly expected that going forward the interest rates are expected to fall, right? How will that impact the returns that we are expecting in the leasing assets, that we are seeing on Grip?
Yeah. So when we started, the interest rates on our platform were north of 20%, or the returns on our platform were north of 20%. I would calibrate. Everything should be looked at in terms of risk and reward. So while the reward was 20%, I think early in our journey, also the kind of investments on our platform were more risky. So 20% was the right reward for that risk. Right? Over a period of time, due to multiple factors, including the initiation of regulation in our space, and now Grip is a SEBI-regulated company. Over a period of time, we have been able to move our products into all investment grade products, which means that they are externally credit rated, having a rating above triple B. Yeah? So 85% of our products fall into that bracket. In very simple terms, the kind of risk has reduced, which obviously means that the kind of returns have reduced. So asset leasing on our platform generates 14 to 16% returns, and there are other products on our platform that generate between 10 to 14% returns.
And the effect of the expected fall in interest rate,
So,
because
yeah,
largely because the rating is anyways, all the products, most of the products that you have, they are rated. So how do you see
I
that?
think again, best is to look at from an arbitrage perspective or a spread perspective. Today, the returns that we are offering are anywhere between 80 to 100% higher than fixed deposits. Yeah. Normally, a fixed deposit is 6 to 7%. Our products are 10 to 16%. So 80 to 100%.
Mhm.
As interest rates reduced, obviously the returns on our products will also reduce, right? Because the market in general will move to a lower cost situation.
Right.
However, I don't think that it will be like for like. So if the FD rates reduce by 100 bips, I don't think the returns on our platform will reduce by 100 bips. They might reduce by 50 bips. So my expectation is that the gap between fixed deposits and the returns on our platform will actually increase, making such products more lucrative.
Interesting, very interesting. So guys, whoever is listening, if you're thinking of investing in leasing assets, this is a better time, before the interest rate
I
starts
think
falling.
I would extend that if you're looking to invest in fixed income, this is a great time because by all means we're at the top of the interest rate cycle, and there are expectation that it will start moving down very quickly.
So longer term are going to be better, longer term
Yeah,
products.
in fact, yeah, absolutely right. And I think somewhere a lot of that education is required. I see a lot of people investing in products like invoice discounting, which is a very short term product. So it's a
Yeah.
2 to 3 month product in the alternative category, but that does not allow you to lock in the rates that are available today. Um, so if you are today investing, you should be looking at a 36-month investment. Anywhere between 24 to 36-month investment, giving you 12% plus, and that's the way to lock in those rates.
Right, right. And the other thing is, Nikhil, this is on the lower side. And even if you're talking about the say the debt mutual funds, right, the long-term debt mutual funds that are there, particularly if you're talking about chips, right, government issued long-term debt. Generally, the maturity is around 10 years. So
Yeah,
you can see it's a very long term. But the other thing is that the expected they're not for retail investors, but for institutional investors, like very liquid, right?
correct.
It's trades very often and trades very frequently. So the volumes on that level is decent, and that is why, because the trades are happening very often, what I see is that the expectation of rate fall is kind of already getting factored in. So a situation or an asset or investment opportunity like asset leasing is something more unique, wherein not everything is factored in, and it's not. And actually, the lack of liquidity here is going to work in your benefit, right?
You're bang on, and that's why the any decrease in FD rates will not pass on 100% to the product simply because there's no liquidity, right? Or liquidity does not exist, and hence mark to market, the market is not efficient enough to determine the prices. So to that extent, some of the arbitrage will continue to.
Right, right. So it's a good opportunity, guys. Think about it. Okay, so now we're talking about risk, Nikhil. Before that, when we are talking about, or when we're selecting a deal, that comes to grip, for people. I'm sure that you would be getting a lot more deals. You'll be filtering it out, and then presenting only a few. So very quickly, if you can, suggest, okay, how is it that you guys control that? Okay, good deals are coming to the platform.
Yeah. Generally, the rule is, what we've seen, about 20% of the deals that go to our investment committee get approved. So it's a fairly rigorous credit process. We have an in-house team that does the business development, does the underwriting. We've had this team also been very stable. It consists of someone from private equity, a big four, couple of individuals who have worked with large banks like ICICI and Kotak in the credit department. So we've really strengthened this team in making sure that it's doing the right credit work. We then take it to an investment committee for approval, and then subsequently it goes to a credit rating agency for them to do an independent process on the credit of the deal. That credit report, independent credit report, is then published alongside every single opportunity. So every single deal on grip will have an independent credit rating. So this is the internal and external process that we do, that allows us to put a deal. Since we got our SEBI license and offered, and now we have, because of the SEBI license, offer something called bonds and SDIs. We've done close to 500 crores in the last 1.5 years, and we've actually seen not a single case of delay or default in any of those products because of this process that we put in place.
Very interesting. And just to get some clarification, the rating that you just mentioned about, this is something that you initiate, right?
Yes.
When the deal comes, okay. So it's not just that what the company actually came to you with, you initiated, so that again having a more independent view.
Yes, we initiated, and it's a mandatory requirement that SEBI has required for platforms to do for the benefit of retail investors. So it's initiated as part of that process.
Okay. And you mentioned that there has been no default in the 500 plus crore that you guys have raised via got invested. But what if there is a default? What systems are in place? Suppose there is a delay or default, that may arise.
Yeah, and like we mentioned in the beginning, every each of these products has a certain level of risk, and people should read the especially the credit reporting very carefully. I think the each deal is structured in a way that there is a security package, which basically means, for example, there is a cash deposit available to dip into in case there is a delay or a default. In each case, there is an over collateralization. So if you have leased assets or securitized assets for 100 rupees, then there are 120 rupees as an example of assets behind it. And then there are various governance requirements that SEBI has put in place for independent parties called a trustee to act in behalf of the investors to protect them. So there are multiple measures and safeguards created. We outline each one of them because they sometimes are deal specific. We outline each one of them during on the deal memos of the page, but this is the broad construct.
Got it, got it, got it. Okay, and Nikhil, I was observing, watching your previous podcast, and you mentioned in one of those, actually two of those, there was some sort of, you were exploring first loss sort of coverage or credit default assurance. What is generally the status on it? How or what you guys are thinking about? Because I understood, when there is a sort of a delay, first of all, you will dip into the security deposit that is there. But what if there is a chance key, or if it happens more than the cash deposit that you have taken, if that is happening.
Yeah. So I would say that in about 75% of the transactions offered on Grip today. So let me rephrase. In 100% of the transactions offered on Grip today, there is a security package which is roughly 120% of the investment value, right?
Right.
So in a way, that additional 20% works as a buffer. Not, I wouldn't call it a first loss or an FLDG, but it works as a buffer. Um, in 75% of transactions, that buffer is up to the tune of 30 to 35%. Right? And there is a different entity taking the first loss that happens in the transaction. Okay, this is done through a combination of security deposit, cash, as well as over collateralization. And I'm happy to go into more details, but this has been structured in a format that is regulatory compliant, and is actually applicable to about 70% of the transactions.
Great, great. So, Nikhil, actually, I would like to, take more details around this,
So
so that we can, share it with our clients, so that they also have just a better understanding of how things function. Mida, any questions we have from the audience so far?
Yeah. So Jatin wants to know ki if you can talk about the tax implications of asset leasing.
sure. Jatin, these transactions are structured through a listed, even the asset leasing transactions are structured through a listed SEBI regulated instrument called SDI, that stands for Securitized Debt Instrument. Under this, the interest that you receive is taxable at your marginal tax rate. And because it is a listed instrument, as under the new budget, whatever is the taxation for listed instruments, which is now the same whether it's equity or fixed income, is the same capital gains tax that is applicable. Because most of these instruments are held to maturity, there is no, as Ankit talked about, there's limited liquidity. So really the taxation that you're looking at is only on the interest, which is the marginal tax rate. The final point to note is that there is a TDS that gets applicable. The TDS in case of SDI is 25%, and in case of corporate bonds is 10%.
I hope that clarifies the question. And if there are any follow-ups, please, please let me know. Okay, so another thing, Nikhil, is the key. Now we are, getting the credit rating from independent agencies. Is there a way? I don't generally generally the quality of data and the amount of data that is available in the country, is still quite limited. Suppose there is a, a deal that has come on grip, and I see that it is, say, triple B rate rated. Is there a way I as a, individual investor who is not subscribing to a number of things, can I check, generally speaking, in the market, what is the currently going rate, yield to maturity, or IRR, for on an average for a triple B rated, similar rated, instrument?
Yeah.
Is there a way for a common man to understand that?
Yeah, there is. So you can I can think of a bunch of ways to do this. You could go to NSE and BSC's website, and the exchanges now provide a tremendous amount of data. So you can actually see the data of every single trade that has happened in the fixed income space on these websites. So if you go and you search for corporate bonds and SDIs, you'll actually get the data for it. The rating will be mentioned, and you will know what was the range of returns offered on those papers. Okay, so you can actually get market data. It's a bit of an effort, but it's possible. Second thing that you could do is, at least certain if you just Google triple B rated corporate bonds, you'll actually get a decent number of hits, and you'll be able to see what it is. And lastly, we publish data, comparative data for every single deal. So if we are offering a triple B rated deal, we'll also add data for what other triple B rated deals are priced at, right? So we try to provide that additional information. So it's possible. I would say that as you go up the rating, so you go to an A, double A, the volume of data will keep increasing. It may be harder to find for triple B, but it'll be very, very easy to find for an A.
Got that. Got that. Okay, cool.
Yeah,
Good
yeah.
for,
So
people to just
people
know.
are talking ratings, but ratings I've realized are not something that many people know about. So maybe just 30 seconds on it. All Every fixed income instrument that is an instrument that is going to give you monthly returns, promised monthly returns over a defined period of time, has to be rated by a agency like CRISIL, ICRA, CARE, which are called credit rating agencies. They're all licensed by SEBI to do this work. A triple A rated product is the highest rating possible, and it almost signifies zero risk. And then there is double A, triple B, double B, and so on and so forth, um, which signify higher levels of risk. So what Ankit and I are talking about is basically that scale. I've tried to explain it to people by calling it by indexing it to large cap, mid cap, and small cap. So triple A is large cap, double A is mid cap, and A and triple B are small caps.
That's a good way to, tell it to people who have already been investing in, equity market.
Yeah, equity.
So, yeah, great. So actually, it's surprising that, I mean, so many products are still, coming in the debt market, but still very limited understanding of people. People have about the debt market, the education. There's a lot of education that still needs to happen here. With a number of webinars, conversations like these, we are trying to educate our clients as well. And it's like, okay, so and still like some basic questions like, okay, so instead of FD, why should I do this? Or instead of debt mutual fund, why should I do this? And if I'm taking risk, equity market is giving me so high returns. Why should I invest it, with grip and only get 13, 14%, 15% return? When just the last year, say Nifty has given 18, 19% kind of return. So just from the perspective of understanding the kind of risk is difficult to understand, right? For particularly for Aam Aadmi, it's very difficult to understand what risk is. For return, numbers are there. Okay, this is the return that I have been making. We are trying to educate that. But okay, as an economy, as a market, it is also a journey that we need to take so
Yeah.
that people can
I
get
think
comfortable.
you're bang on, and I think the reasons are till 2 years ago, uh, access to this market was impossible. Right, the biggest challenge was that minimum investment amount was 10 lakh rupees.
Yeah,
So, most of us learn what to invest in over family conversations or friend conversations, and I don't think any of us heard the term corporate bonds or asset leasing because most people were not investing 10 lakh rupees in a single instrument.
yeah.
The fact that you can now do it at 1,000 rupees or 10,000 rupees is changing the it's a paradigm shift, and there will be more conversations about fixed income and why that makes sense. I'm hoping is that people also talk about long-term returns in the stock market rather than short-term returns in the stock market, and then compare the two asset classes.
Well, absolutely, I agree. I mean, but the thing is, like, generally, we as humans, we are like, there is a recency bias, right? Whatever we are seeing in the just short term, right? Like last 6 months, 1 year or so, that is what we remember. And when there is a crash, there'll be so many people who will just exit the market just because there was a crash. I mean, the worst time to exit, but after the equity market, I mean, and that is when they'll exit and they'll be like, the equity market, the stock market is a gamble. Right? I mean, I'm
Yeah,
sure you must have heard it, particularly from our previous generation. You would have heard, stock market is a gamble because partly it's also they have seen the Harshad Mehta situation and few others.
yeah.
So
I'm
affected
actually
like
very worried that if the stock market crashes, a lot of people will not only exit the market but will be off investments
yeah.
because you burnt your hands very early in your life, and you just suddenly again have recency bias towards it.
Yeah. And probably just going it back to very traditional investments like fixed deposits and whatnot. So, and what people also don't realize is that even fixed deposit is not 100% secure. Only up to 5 lakhs is secure, right? And people want better returns, so they want to go for many times they're opening FDs in smaller banks. They don't realize and they don't realize only 5 lakhs is say secured, and there have been instances right wherein even banks have sort of got into trouble, maybe failed, not failed, various situations. But people don't, again, lack of education there.
Correct, and there
So
is no security and there's no FLDG for those for sure. Yeah.
yeah, absolutely. Okay, Amita, any other questions?
No other questions here, but Nikhil, just to share, right? So before this session started, we did a poll in our community, and we tried to understand, okay, why would you invest in, something like asset leasing, and why, what are your concerns around it? So it will be really funny to note that the number one reason why people don't want to invest is because of the higher risk, and the number one reason why people want to invest is higher returns. So
Yeah,
risk भी नहीं लेना है, return भी चाहिए. So
yeah,
like I think that is the mentality that people have, and I think that's just how we are, right? Like we just want everything in the world,
yeah,
and like you guys were rightly talking about, like people don't really understand this. They don't know how to quantify it, and what I would like to know is that, like, a lot of the people in our community, people following us, watching us, are real beginners to investing. One of the things that we help them with is figuring out, okay, how should their portfolio look like, because diversification itself is misunderstood. So we have people who have invested in 50 different stocks or 50 different mutual funds, and they think that their portfolio is diversified, where those 50 mutual funds are all equity mutual funds, and they will try to be very cool
Yeah,
and
so
invest
large
in
cap from
specific
company A, large cap from company B, large cap from company C, and yeah, our portfolio is diversified. That is what
yeah,
many times
yeah.
people think. So
So I think it would be interesting to, just talk in a very simple way and let us know, like, where does this fit into my portfolio, right? Like if I was a beginner and I'm trying to, and I understand that this is not for beginners, But let's say that, okay, I have reached a point where I'm comfortable now to invest in this, take that kind of risk. So, how does this sit in my overall portfolio?
Sure. Great question, and I'll just extend it to a little broader fixed income products that we offer, because it can then answer the question for different set of users. I think if you are early in your journey, let's say you are 22, you just begun your career, you're doing your first year of savings. Um, there are products like corporate bonds, which are AA rated, which have a minimum investment value of just 1,000 rupees. Okay, I think those fit very well into someone's portfolio from a diversification point of view and exposure to this asset class. Ultimately, what are you trying to do from diversification is that while the stock market has volatility, fixed income has no volatility, right? So every day that the market goes up or down, fixed income just stays stable. So there is very little correlation between stock market and fixed income market, and that is what you want to do with diversification, right? Large cap companies are all correlated to each other in some way or the other. So to that extent, I think a good place to start for someone early is a corporate bond with a 1,000 rupee and now 10,000 rupee ticket size. I think as you go to your 30s, towards your 30s, we have a product called LoanX and InvoiceX, which, Ankit, to your point, are the ones that have FLDG, and we can speak more about it later. Those are products that give you 12% returns. Okay, for people who are neither to your survey who want both a good risk and a good return. Now, it's not possible at 16% to get no risk, but at 12 to 13% products, the kind of ones that we offer, give you very little risk and a fairly good return, right? Long-term returns on the stock market are in the range of 14 to 15%. So 12 to 13% with stability, I think is a fairly compelling proposition. And then I think the last category is asset leasing. There also there's a range, right? Again, rating range, but generally I would say that those are the more riskier products where you can get to 14 to 16% and to look later in your portfolio. A rule of thumb that I've come across, and I think it's a simple way to explain it, is that if you have whatever your so you have whatever your age is, subtracted from 100, okay, and that's the amount of money that you should have in equities. The rest you should have in fixed income. Okay, so if you're 20, 80 in equities, 20 in fixed income. If you're 50, it should be 50-50. And you can do the maths. So I think that's a good rule of thumb. And now there are different products at different stages that you can bring into your life or your portfolio, which will allow you to solve for the diversification.
Perfect. Thanks, Nikhil, and thank you for letting us know about the entire spectrum as well. That was really
Nikhil, you
helpful.
mentioned here about corporate bonds. So say I am just started working and I don't know much about the market and first year, second year of my job. So corporate bonds versus debt mutual fund.
Yeah.
Which one should one go for?
So, majority of the debt mutual funds in our country today are largely around government securities, GSECs or AAA rated bonds, and that allows you to solve for 8-9% returns today. Unfortunately, so the debt mutual funds are not that attractive from a return perspective, especially people who are looking to have a higher return in their portfolio. I think corporate bonds give you that flexibility. So you could create your own mix of corporate bonds, which will give you 10 to 12%, and still are A to AA rated. In fact, to solve this, Ankit, we came out with a concept called baskets. It's very similar to what small case offers. So we've created theme-based baskets, which are a collection of bonds, and you can choose which basket to invest in, and that allows you to achieve the benefit of the mutual fund diversification, but still the advantage of higher returns from a corporate bond. So I think that is in simplicity the difference. There are many others. Taxation is different, payouts are different. In a mutual fund, you have to exit to get your returns, and at the time of exit is always a capital gains event. But in case of corporate bonds, it's always an interest income event. So I'm keeping those differences aside, but the basic difference is the kind of returns you can expect from direct investing versus a mutual fund
And the basket that you talked about, will it be taxed as a bond or as a mutual fund?
as a bond.
Alright, cool. Okay, so one question that I have personally, I have been investing in number of deals personally that is coming up
That's good.
on
Yeah. Okay.
Yeah, I mean, so we came to know about Grip about 2 years back, and since then I have been investing, and a lot of our clients have been investing. They are, very happy with the investments that have been there. One thing that I'm not happy about, and a lot of my clients are not happy about, is that we don't need the money back, like
Yeah,
money that we have invested. And I understand there are certain regulations around it, but the monthly or quarterly payments that we are receiving. So the clientele that we have, these are people who are between the age of 25 and 40, most of them making decent money, and they don't need the money, they don't need the returns right now. They want what they're looking for is a long term wealth generation. So whatever investment that they have made, it should just keep multiplying over time. So, is
yeah,
there any way wherein the monthly or quarterly payouts that we are getting that can be reinvested in a way that it can continue to give similar, if not same, return that I initially got into?
yeah. Yeah, it's a big problem statement, and you can imagine that as a business, it's also something uh, that money not being reinvested is a big loss for us, right? So I think we're aligned to solve for it. However, the regulations are very clear. The money needs to go back to the investor's bank account, and we cannot create a automatic reinvestment of it. So it's regulatory is a regulation is the restriction. Couple of things that we are doing to solve it. Number one, for investors who have a larger portfolio, say 25 lakhs, we have, sorry, 50 lakhs, we have come out with a PMS strategy, a portfolio management scheme strategy for debt products. So the same products you see on a platform, which are corporate bonds and SDIs, can now be accessed through a PMS. Now, in a PMS, the reinvestment is possible. Okay, but the challenge is that the minimum ticket size is 50 lakh rupees. The second thing that we're doing is we're coming out. We've actually launched already in beta a SIP program. So you could subscribe to a SIP, and then say every month X amount of money will get invested, which is in a way solving for your reinvestment, right? The third thing, which is interesting, is SEBI came out with a discussion paper on a new asset class a few weeks ago, which has a minimum ticket size of 10 lakh rupees.
Right.
The idea is to sit between a mutual fund and a PMS, and depending on how that regulation comes, that could be a really interesting way to solve for what you're saying.
But that is more for AMCs, right? AMCs can do that. Will you be? I mean, will Grip be allowed to run a similar? I mean, I
I
don't know
think
if you
there are
can.
a way to. I think we'd like to see how we can partner with someone to make it happen, where the products are ours, but the AMC and obviously the management lies with someone else. But I think those are all possibilities if the regulations permit products like corporate bonds and STIs.
Okay, okay. And you also mentioned about the SIP, so that is actually very good and interesting. So when I'm reinvesting, the SIP that I'm doing, that will be reinvested, of course, at the current funds or something that are available, right? The bonds or SDIs that are available.
That's right. So every month you will invest in a new bond, the SIP amount.
Okay, this is super helpful, super exciting. Nikhil, apart from what you mentioned about the SIP and the PMS that you guys have already started, what next? What else can we, what's cooking at Grip?
So, to me, the product suite that we offer is really exciting. I think it's performed well. I think it's a good diversity, 10 to 16% returns, tenures from 4 months to 48 months, AAA rated to triple B rated, right? So, whatever risk reward tenure an investor is expecting will be available. I think it's good to have a fully regulated business. The big focus now is really around investor experience, right? The kind of stuff that you talked about, because the just the product by itself will not is not enough. Investors are also expecting to have a great experience when they come to us.
Yeah.
So pain points like reinvestment, pain points like SIP, pain points like ability to invest 24 by 7, pain points like baskets have gotten solved by initiatives we have taken in the last few months. The big one we are focused on now is liquidity. The market is not liquid, but we want to offer liquidity to our investors where they can sell bonds back to us whenever they want, okay, and exit. So this is the big one. We have already launched a beta for it a few weeks back,
Okay.
and we allowed 200 users to subscribe. Opened it up for 200 people who signed up for it first. Based on the performance the next couple of months, we will roll it out to all our users.
That'll be great. Because again, given just how the situation and the size of the fixed income market in India is, I mean, this liquidity is a major concern why a lot of investors don't come in. He, I can put aside whatever, say 2 lakhs, 5 lakhs, 10 lakhs, but I don't want to be stuck for 5 years or 10 years, particularly for the longer ones. So
Yeah.
when people have the affordability, people have the funds, and they can't even seek if they will be needing it, not or needing it sooner or not. Still, they don't go for it. Like, blocking that fund key. The control is not in my hand. So if something like that happens, of course, that will make a huge difference, and probably it will also help. And of course, the platforms like yours, they are doing a great job in bringing this kind of investment to the Aam Janta, because and Aam Janta is becoming, small retail investors becoming incredibly powerful now. The SIPs have crossed, in mutual fund has crossed 21 lakh, 21,000 crores per month. So they have a lot of momentum going on. It's just that when these things are there, I think it will help us grow as a market as well. And compared to other
Absolutely.
markets that are there, wherein fixed income market is many a times bigger than equity market, and we are what a fractional. You probably have the better number, right? Fractional. So, I mean, this is the size of the fixed income market is very small. So I'm sure.
Yeah, so actually, India's fixed income market is also larger than India's equity market.
Is it?
So yeah, so every year, and there's an interesting data point from SEBI. 80% of all fundraisers in India is fixed income. Only 20% is equity.
Interesting.
So yeah, last year there was 105 billion dollars of bonds issued versus 18 billion dollars of equity. So it's a magnitude difference. Fixed income markets are much larger. It's just that it has not been accessible to the retail investor. Right? They've always
Yeah.
been institutional. So in the case of retail, it's the opposite story, and that's what SEBI's regulations, the work that the exchanges are doing, the work that OBPP platforms like us are able to do, I think should make a dent to that.
So we are already seeing, some growth has already started happening. So it's
Yeah,
just now talking about gaining that momentum, so that the things
absolutely.
just happen faster, and the scale at which retail investors are participating, it just goes up faster. So great. Nikhil, thank you so much for your time. Really appreciate, love the conversation. A lot of new things, that I learned, and I'm sure our listeners also learned. So thank you so much for your time. Continue, bringing in amazing transactions, deals on your platform, because we definitely keep watching out for those. I mean, one thing that we keep complaining is the key. There are not enough or not as frequently. We're not getting as frequently that these X deals that are coming. So I'm sure you guys are working on that, but it's also important
Yeah.
to maintain the quality. So,
No, absolutely. No, thank you so much, Ankit and Medha, for this. Look forward to keep collaborating. Just to your last point, we have an really interesting LeaseX transaction coming up in the first week of September. So I'll drop you a line once it's live. Yeah.
sure, sure. Please do. So
Okay.
now I've sort of estimated. Okay, so approximately we are getting one lease X every quarter. So we kind of getting prepared for
Yeah,
that.
I would love for you to check out LoanX, and we should talk more about it. But I think that is a really interesting risk reward. It's also a much larger market. It's a market that today is almost only offered by Grip. Otherwise, it's entirely institutional. But I think the combination of the FLDG, the kind of structuring that we're doing, and the credit, plus the returns, are actually very attractive.
Sure. Let's connect offline, Nikhil. So before we offer any product to our clients, I personally invest my own money to
Got it.
understand how the function, how how it functions, the kind of risk, return, experience, everything. So let's connect, and if it makes sense, of course, we like to bring it to our clients.
Sounds good. Perfect. Okay.
Awesome. Thank you so
Thanks.
much.
Thanks for everyone joining on 15th August. Happy Independence Day.
Happy
And
Independence Day.
thank you
Thanks to you
again.
too for this.
Thank you. See you.
Thank
Bye.
you.
Thanks so much, Nikhil, for your time. And yes, happy Independence Day to everyone who's watching. And it was a chutti, but you took out time to do this. So thank you so much for that. So today's topic was about asset leasing. And I'm glad that so many people, that Nikhil and Ankit did touch upon corporate bonds, because next week we'll be talking about corporate bonds with Anshul from Wind Wealth. So join us on Thursday, 8 p.m. again, and we'll be talking about corporate bonds. And like we talked about, it's a great time to be in the fixed income investment space. So watch out for that. Thank you so much. Thanks once again, Nikhil, Ankit, everyone who's watching, and have a great week ahead. And if you're on a long weekend, have a great long weekend ahead. All right. Bye bye. Good night.